Let us see the next question. XYZ Limited has following book value capital structure. So book value capital structure is given to us. Equity share capital rupees 15 crore, shares of rupees 10, fully paid up at par value. It means that the company has issued 1.5 crore equity shares having face value of rupees 10. Next, 11% preference share capital of rupees 1 crore, 100 rupees is again the face value and fully paid up. Retained earning, that is reserves and surplus, is given to us. 13.5% debentures, rupees 10 crore, and 100 rupees is the face value of debenture. 15% term loan of 12.5 crore. The question says that the next expected dividend on equity share per share is 3 rupees 60 paise. So we have been provided with the D1 information, 3 rupees 60 paise. The dividend per share is expected to grow at the rate of 7%. So the growth rate in dividend is given 7%. The market price per share is rupees 40. So P0 is given 40 rupees. Preference stock was issued before 5 years for 15 years. It was issued for rupees 90. Currently it is selling for rupees 75. Debentures redeemable after 6 years are selling at the rate of 80 rupees per debenture. So again the price is given to us for the debenture. Income tax rate is only 40%. Calculate weighted average cost of capital using book value proportion, using market value proportion. So we are required to make the computation of the weighted average cost of capital by two methods. One is the book value proportion and another is the market value proportion. Friends, we understand that whether we compute the weighted average cost of capital using the book value weights or using the market value weights. In either of the case, listen carefully, in either of the case, the cost of capital is going to remain same. So first of all, we are required to make the calculation of the cost of capital for the individual source of finance, and then we'll apply we'll compute the weight as per the book value, as per the market value, and weight into cost of capital will give the weighted average cost of capital. Answer of the question. In this question, we have to compute weighted average cost of capital using book value and market value proportion. Full stop. With paragraph breakdown. In either of the case, cost of capital is going to remain same, only weight / proportion is going to change. Full stop. Now friends, we are required to make the calculation of cost of capital for individual source of finance in a way that say for cost of equity, cost of preference share, cost of retained earning, cost of debenture and cost of term loan. These five things are required to be computed. Again we can see that say neither flotation cost nor information about the personal tax rate of the shareholder or brokerage information is given. So cost of equity and cost of retained earning would be same. With paragraph breakdown, information about flotation cost, comma, shareholders personal tax rate, comma, brokerage have not been given. So cost of equity and cost of retained earning would be same. We have been provided with the information about the equity share, preference share, debenture. So we will make the calculation of the cost of capital in that. First of all, cost of equity. Calculation of cost of equity. I want you to calculate the answer first and then I will do working for you. So cost of equity will be found as D1 divided by P0 plus growth rate. That is the way the cost of equity can be found. The D1 information is given to us as 3 rupees 60 paise. Current market price is given as 40 rupees and growth rate is given 7%. So what will happen? 3 rupees 60 paise divided by 40 rupees plus growth rate 0.07. So what will happen friends? We understand that say 3.6 upon 40, 0.09 plus 0.07. So that comes to 0.16, that is 16%. That is the way first of all KE will be calculated. After writing the answer of KE, I want you to tell me answer of cost of preference share. That is the next information which they have provided. Tell me cost of preference share. Friends, in case of the cost of the preference share or cost of the debenture, the very first thing that we have to consider, what we have to take into account is that say whether the security is redeemable or irredeemable. We can see that the question is providing the information that it was issued before 5 years for 15 years. Means clearly we have been provided with the information that the security is redeemable in nature. That is the first thing. Now if at all the security is redeemable in nature, then in that case we will apply the formula like this for calculation of the cost of preference share. Let us heading calculation of KP cost of preference share. It will be preference dividend plus redemption value minus amount received divided by number of years whole divided by redemption value plus amount received into 1 by 2. This is the way we are required to make the calculation of answer. Why? Because the security is redeemable in nature. We have been provided with the information that as far as the preferential is concerned, it has a face value of rupees 100. Rate of preference dividend is given as 11%. So what will happen over here? It is 100 rupees into 11%. Plus, we have been provided with the information that it is selling at the rate of rupees 75. Regarding redemption value, no information is given, so we assume that the redemption value is equal to the face value minus amount received divided by the number of, that is divided by number of years, whole divided by redemption value plus amount received into 1 by 2. That is what we understand. Now dear students, we understand importantly over here, we have been provided with the information for the existing security. So whenever information is provided to us for an existing security, we are required to compute the cost of capital if such a security is going to be issued in the market today. So if at all we issue this kind of security today in the market, then in that case we will be able to fetch an amount of rupees 75. We understand that the information which is provided to us regarding this 90 rupees is useless. Why? Because it was the historical price at which it was issued. So as far as the amount received is concerned, we will take 75. Because we want to know that what would be the cost if at all we issue such a security today in the market. Then information is given, it was issued before 5 years for 15 years. So from today we understand that 10 years is remaining. So with this we are required to make the calculation of cost of capital. So over here 11% of 100 rupees comes to 11 plus 100 minus 75, that is 25, divided by 10, that comes to 2 rupee 50 paise. Whole divided by average of these two values, 100 plus 75, 175 divided by 2, 87.5. So here the numerator is 13.5 divided by 87.5. That comes to 15.43%. That is the way the cost of debt financing is calculated. Cost of preferential capital. After this, calculate the cost of debt financing on your own. Dear students, in case of the debentures also, the very first thing that you need to verify is that whether the security is issued for perpetuity or the security is issued for a certain time period only. We can see that the question is providing the information. The debentures are redeemable after 6 years. So we understand that it is going to be redeemed after 6 years only. That is, the remaining time period is only given to us in the question. And selling at the rate of 80 rupees per debenture. So the P0 is given as 80 rupees. Income tax rate is 40%. So in case of the cost of debenture, that an answer? Calculation of KD, cost of debenture. It will be interest into 1 minus T plus redemption value minus amount received divided by the number of years, whole divided by redemption value plus amount received, whole into 1 by 2. We have been provided with the information once again that the face value of the debenture is 100 rupees and the rate of interest is 13.5%. So 100 rupees into 0.1350 into 1 minus income tax rate. We have been provided that the income tax rate of the company is 40%. So into 1 minus 0.40 plus redemption value is 100 minus the amount received. The question says that the current price is 80 and going to be redeemed after 6 years. Divided by 6 whole divided by 100 plus 80 into 1 by 2. That is the way the answer is to be found. So 100 into 0.135, that is 13.5 into 0.6, that comes to 8 rupee 10 paise, plus 100 minus 80, that comes to 20, 20 divided by 6, that is 3 rupee 33 paise, whole divided by average of the redemption value and the amount received. So 100 plus 80, 180 into 1 by 2, that is 90. So the numerator is 8.1 plus 3.33, that is 11 rupee 43 paise divided by 90 rupees into 100 for getting answer in percentage term. So the final answer comes to 12.7%. That is the way the cost of debenture will be calculated. So by using this simple formula, KD is 12.7%. So friends, we have computed cost of equity, that itself is the cost of retained earning. Cost of preferential is also done, cost of debenture is also done. For term loan, no other information is given, so we can compute the cost of term loan like this. Calculation of cost of term loan. It is interest into 1 minus T divided by amount. That is the way we are required to compute the answer. It is 12.5 crore and this is 15%. So it is 12.5 crore into 15% into 1 minus tax rate divided by 12.5 crore. So as per the discussion that we had in the previous lecture, you can very well understand that this 12.5 crore is cancelled against this 12, that is 12.5 crore. So what will happen? 15% into 0.6, that comes to 0.09, that is 9%. That is the way the cost of term loan can be calculated over here. Once you make the computation of the cost of term loan, afterwards calculation of weighted average cost of capital using book value proportion. In that, say the simple answer is column number 1 is the source of finance, column number 2 is amount, column number 3 is weight or the proportion in which the funds have been raised, cost of the individual source of finance, weight into cost. That is the way we are required to do weighted average cost of capital calculation. Let us see now. The column number 1 is the source of finance, equity share capital. So column number 1 is the equity share capital. The amount is 15 crore. Next, preference share capital is 1 crore. Next, retained earning is 20 crore. Next, 13.5% debentures is 10 crore. And the last is the term loan, 12.5 crore. That is the way we will make the calculation. So 15 plus 1, 16, plus 20, that is 36, plus 10, 46, plus 12.5, that is 58.5. So the total comes to 58.5 crore. Then we'll compute the weight. So it is 15 divided by 58.5. So the answer comes to 0.2564. Then it is 1 crore divided by 58.5 crore. 0.0171. 20 crore divided by 58.5. 0.3429. So 3419. 10 divided by 58.5. That comes to 0.1709. 12.5 upon 58.5. 0.2137. Let us have a verification that so the total is 1. If it is not 1, then in that case usually the last weight will be taken as balancing figure. 0.2564 plus 0.0171 plus 0.3419 plus 0.1709 plus 0.2137. The total is exactly 1. So no changes are required to be made. As far as the cost of equity is concerned, that we have found it, I think that it is 16%. So this is 16%, as well as the cost of return on equity is 16%. Cost of preference share capital is 15.43 and this is 12.7. So 15.43 and this is 12.7. Cost of term loan is 9%. So the weight into cost, weighted average cost will be found, and that weighted average cost of capital is considered to be the overall or weighted average cost of capital. Usually my suggestion is to take 4 decimals in the weight and cost into weight, in that I suggest 2 decimals. So 0.2564 into 16. So it comes to 4.10. So 0.2564 into 16. Next, 0.0171 into 15.43. Point 26. 0.3419 into 16. 5.47. 0.1709 into 12.70. 2.17. 0.2137 into 9. 1.92. So it is overall it is 13.92%. That is the weighted average or overall cost of capital. Now B part of the question, it says that so you are required to compute the answer using the market value proportion. So instead of taking the book value of the security, we will take the market value of the security. And in that we understand that importantly we have to be careful that the market value of the equity share capital is divided into book value of the equity and book value of the retained earning. So let on heading calculation of weighted average cost of capital based on market value proportion. That is what we are required to do. So in that, working note number 1, calculation of bifurcation of market value of equity into book value of equity and book value of retained earning. So over here, column number 1 is source of finance, column number 2 will be book value, and column number 3 will be market value. In the source of finance column, I am writing equity share capital and retained earning. That is the way these two things will be mentioned. As far as the equity financing is concerned, it has been given it is 15 crore and retained earning is 20 crore. So over here this is 15 crore, this is 20 crore, so the total is 35 crore. Market value. The question says that the market price of the equity share is 40 and we can see that the face value is rupees 10. So as far as the market value is concerned, it is 15 crore divided by 10. That will give us the number of equity shares into 40. That is the market value and that is an amount of 60 crore. Okay. Now we'll convert this market value into book value of equity and book value of retained earning. So 15 crore divided by 35 crore into 60, and the remaining will be for the retained earning. So 15 into 60 divided by 35, that comes to 25.7143. We can say it is 25.71, which is subtracted from 16, so it is 34.29. That is the way the market value of the equity share capital 60 crore will be segregated in both of them. Heading right down, calculation of weighted average cost of capital based on market value proportion. In that way, we will work out the answer like this. Column number 1 is the source of finance. Column number 2 is amount. Column number 3 is weight or proportion. Next is cost of capital, weight into cost of capital. With that, we will compute the weighted average cost of capital. So we start with the equity share capital. It is 25.71 crore. Next is preference share capital, which has a face value of 1 crore divided by 100. That will give the number of preference shares multiplying with the price per preference share is 75. So we understand it is 1 crore divided by 100 into 75. That comes to 0.75 crore. The next is the retained earning. The amount of the retained earning is 34.29 crore. The next is the debentures. It is 10 crore. So 10 crore divided by 100 multiplying with the market price of 80, that is currently selling for 80. So this is 8 crore. In respect of term loan, in absence of any information, we'll assume that the book value itself is the amount received. That's it. We'll compute the weight. Cost of capital will remain same, importantly, whether it is book value approach or market value approach. And lastly, we will have the weighted average cost of capital to be calculated. So 25.71 plus 0.75 plus 34.29 plus 8 plus 12.5, that is 81.25. Okay, we'll compute the weight. It is 25.71 divided by 81.25. It is 0.3164. 0.25 divided by 81.25, 0.0031. 34.29 divided by 81.25, that is 0.4220. 8 divided by 81.25, 0.0985. 12.5 upon 81.25, 0.1538. Let us verify the weight total. 0.3164 plus 0.0031 plus 0.4220 plus 0.0985 plus 0.1538. Okay, so the total is not exactly the one. So for the last one, I am taking the balancing figure. Set is okay. Here for preference share capital, there is an error from my end. 0.75 divided by 81.25, so 0.0092. Please incorporate this correction. So again, the total is not matching. Why? Because it is 0.99999. So what I am doing, I am taking the weight for the last security as 0.1539, so that the total would be exactly 1. Now we understand that the weight into cost of capital. The cost of equity is 16%. Cost of retained earning is also 16%. Preference share cost is 15.43, debenture it is 12.7, and for term loan it is 9%. So weight into cost, weighted average will be found. Now friends, there is one of the question to which I come across number of times. Students are having a question to ask me, sir, I was thinking like this. Let's say, can I take the equity share capital and retained earning combined for the purpose of doing answer? That is in equity financing, if at all I mentioned 60 crore, is that okay? That is the kind of question that the students are asking. Giving reply to that question. In this question, it will be okay. In this question, if at all you do like that, then in that case it is okay. Why friends? Because in this question, cost of equity and cost of retained earning are same. Had there been a situation that say both of them are different, as what we had in the previous example, that is say in one of the questions that we did earlier, shareholders percent tax rate was given. In that case, doing like that would not be acceptable. In this kind of question, when cost of equity and cost of retained earning are same, then in that case you may not bifurcate. So generally my suggestion to all of you is, let's say always do the bifurcation. It may not be required, but doing that say will not have the wrong answer. So weight into cost. 0.3164 into 16. So 5.06. 0.0092 into 15.43. 0.1420. 0.4220 into 6. So 2.53. 0.0985 into 12.7. So 1.25. 1539 into 9. 1.39. This is the way we compute the weighted average cost of capital or overall cost of capital. So it is 5.06 plus 0.14 plus 2.53 plus 1.25 plus 1.39. It comes to 10.37%. That is the way the answer is calculated. There is a mistake on my end. 0.4220 into 16. It is 6.75. So 5.06 plus 0.14 plus 6.75 plus 1.25 plus 1.39, that comes to 14.59. So this is 14.59. That is the weighted average cost of capital. Right on with paragraph. In this type of question, comma, in which cost of equity and cost of retained earning are same, comma, we may not bifurcate market value of equity into book value equity and book value retained earning. Full stop.